So welcome all to today's class. We want to continue from where we had stopped yesterday. So yesterday we looked at statement of cash flows. We did three examples. There was the short first example that showed us how to calculate cash generated from operations using direct method. Remember, using direct method, we said you take cash received from customers, you less cash paid to suppliers, you less cash paid to employees, you also less cash paid for other expenses. Now, how do you get cash received from employees? By preparing receivables account. How do you get cash paid to suppliers? By preparing a payables accounts. And remember, it is trade payables. So if there are any interests, if there are any purchases of non-current assets, you must remove them from the trade payables. We only use trade payables. Payables to purchase of goods. When you purchase goods, that is when it is trade payables. Purchase of inventory, purchase of stock that you will sell to your customers. Now, how do you get payment, cash paid to employees? By preparing an expense account. Remember, in a normal expense account, opening balance accrued is on the credit side. Closing balance accrued is on the debit side. If it is an income, it's the opposite. If it's an income, opening balance accrued is on the debit side. Closing balance accrued is on the credit side. Always just at least remember one, and then you reason with the others based on the one. Just remember that if it is an expense, opening balance is a credit. Accrued. So if it is prepaid, it is on the opposite side. Only remember one transaction. If it is an expense, opening balance is on the credit side. If it is an income, opening balance is on the debit side. If you remember that, it's okay. So we also looked at cash generated from operations in example 2 using indirect method. And we agreed that indirect method is the most commonly set in exams. Now, under indirect method, you start with profit before tax. You add any finance charges. You less any income that is there. You add any depreciation. You add any impairment, be it of intangible assets or tangible. Any impairment, you add any impairment. You less any profit on disposal. You add any loss on disposal. What else did we say? If there is an increase in inventory, you less. If there is a decrease in inventory, you add. If there is an increase in receivables, you less. If there is a decrease in receivables, you add. If there is an increase in payables, you add. If there is a decrease in payables, you less. That is indirect method. The answer you get gives you cash generated from operations. I hope we are clear there. There is a reason why I'm stressing, because that is the most important part of cash flows. Now, that gives you cash generated from operations, and that is the item you take in the main body of statement of cash flow. Now, when you have now come to the statement of cash flow operating activities, the first item is cash generated from operations, and it will be a working one because you have calculated it using either direct or indirect method. So once you get this cash generated from operations working one, you less any interest paid. You know interest paid is an expense, so you open for it a T account. Opening balance, credit side. Closing balance, debit side. Income statement, credit side. The balancing figure will be on the debit side. It will be the cash paid. You less that. You also less income tax as paid. Income tax what? Paid. Opening balance, credit side. Closing balance, debit side. Income statement figure, credit side. The cash paid is on the debit side. Dividends paid. Let me be very clear in dividends paid. In dividends paid, IAS 7 tells us you can either take it to operating activities, investing activities, or financing activities. Most people put it under either operating activities or financing activities. Myself, I chose to put it under operating activities, but some people put it under financing activities, which is still right. It is still correct. We move on to investing activities. Under investing activities, you look for purchase of non-current assets. How much was paid to purchase a non-current asset, be it tangible or intangible? So long as it was purchased, you account for it. It is negative because it is a cash outflow. You look for cash proceeds from disposal of non-current assets. It is a cash inflow, so you add it. You look for any interest received. It is a cash inflow, you add it. You look for any dividends received. It is a cash inflow. So I've talked of 4 items. They may even be more because sometimes we have both tangible and intangible. So you separate them. We may have purchased tangible and we may have also purchased intangible. So those are 2 in 1. So we have looked at that. Finally, financing activities. Financing activities, you look at proceeds from issue of shares. When you are looking for proceeds from issue of shares, take note of this. You look for it under both share capital and share premium. Don't only concentrate on share capital. Look for both share capital and share premium, because when we issue new shares above the nominal price, the amount above the nominal price goes to the share premium. So you account for both the share capital and share premium. Sometimes You may also repurchase shares. Okay, before I go to repurchase of shares, issue of shares. Sometimes you issue shares for free. You issue shares for free. That is bonus issue of shares. Remember, bonus issue of shares, there is no cash inflow. Number of shares increases, but there is no cash inflow. So always remember to deduct. Always remember to deduct any bonus issue of shares before you calculate cash received from issue of shares. If there is any bonus issue of shares, you deduct it because there is no cash inflow. You remove it from the proceeds. You remove it because there is no cash that the business received. Okay, now I'm going to repurchase. In repurchase of shares, we said that if there is any repurchase of shares, it is a cash outflow. You deduct it. You go to the loans. If there is an increase in loans, that is, it means there was an amount borrowed, you add. If there is a decrease in loans, it means there was a payment made, you deduct. Now you get the total of operating activities, which is either used negative or from positive. Investing activities, either used or from. You'll realize in almost, I've not said all, in almost all, I've not said all, in almost all investing activities. In most cases, it is negative. Why is it negative? Because most investments are cash outflows. So you will find that in most statement of cash flows, investing activities are negative. So remember, you call it net cash used in investing activities. Now you add net cash from operating activities plus net cash from investing activities, or minus net cash used in investing activities plus net cash from financing activities, or minus net cash used in financing activities. The answer you get is either an increase or a decrease in cash and cash equivalents. You add cash and cash equivalent at the beginning of the year. The answer you get is cash and cash equivalent at the end of the year. Now, I always receive very, very many questions in my WhatsApp. Sometimes it's very difficult even to respond. Imagine now we are 84 people. If in a day, 30 people send me questions, and that is only financial reporting. I'm teaching 5 different subjects. 5 different subjects. You can imagine the amount of questions I receive. What I'm trying to say, only send me a question if you have discussed with your friends and you have not resolved it. That is when I should step in. Otherwise, I'll run mad because questions are really too many. So discuss with your friends first. If you fail to agree, is when you refer to me so that we are all productive. You know, during revision, we'll also cover more. So that we are all productive, try as much as possible to discuss amongst yourselves. Because imagine I'm teaching 5 different subjects. And you can see in one of the 5 subjects, the class is 115. Not all people have joined class. So imagine if 30% of the class were to send me questions. You can imagine how tiresome it is. And then multiply that by 5. You see how many questions I receive in a day. And that is only in CPA. I also teach ACCA. I also teach other. So it's really, the point I'm trying to say, minimize the questions, discuss with your friends. If it cannot be solved with your friends, is when you forward to me. However, that does not stop you from forwarding me questions if you feel it's really burning. Now, today morning, I received a question. I don't know if it's morning or yesterday evening. Somebody was asking me, how do we account for discount received from suppliers? Discount received from suppliers. Remember, discount received is an income. Please take note of that. Discount received is an income. Now, if discount received is an income, but in that income, we have not received any cash, it is an income that is a non-cash flow. You have received a discount from the supplier, that is an income, but it is an income that is a non-cash flow. What is the effect of discount received in the income statement? It increases our profits. Discount received increases our profits. So if it increases our profits, in the profits you add it, yet it is an non-cash flow. So if there is any discount received, the point is this: you deduct it from profits when making the cash flow statement, because it is an non-cash flow which had increased profits, yet it was an non-cash flow. So if there is any discount received, what do? When you are calculating profit before tax, you add back finance charges. Remember to do what? To less discount received from suppliers. Remember to less discount received from suppliers. The opposite of discount received is discount allowed. So if discount received is deducted, of course, obviously, discount allowed will be added back. There is also another question I received, but I forgot to note it down. I thought I will remember it. If I remember it with time, I'll also answer it. So let us, if I was to answer all questions I received, it will be a class on its own. We will not move forward. So let me again. Somebody's asking me why impairment is goodwill is added back. It is the same reasoning as depreciation. Why is depreciation? Depreciation is loss in value. Why do we add back depreciation? Because it is a non-cash flow. So why is impairment on goodwill added back? Because it is a non-cash flow. Because it is a non-cash flow. I hope I've answered you. So why don't we now start the class from there? There are some questions I received, which of course I've said if I was to answer all questions, it will take me a lot of time. So discuss amongst your friends. I just chose the ones that I felt I needed to explain. So let's look at consolidated statement of cash flow. I shared the question in the group. I hope, as I requested you, I hope you had read the question. I hope you had read the question. Now, consolidated statement of cash flow is one of the easiest topics if you understand it. Now, why am I saying this? It is exactly same as the other statement of cash flow we did yesterday. Exactly the same. The only difference is that the examiner gives you consolidated financial statements for 2 years if it is balance sheet, and for 1 year if it is income statement. That is the only difference. The examiner gives you consolidated financial statements. The examiner gives you consolidated financial statements. In what we were doing yesterday, they were not consolidated. They were separate financial statements. So it is exactly, everything is exactly the same as the cash flows we did yesterday. The only difference is financial statements are what? Consolidated. Oh, Jado, your question, how do you know an non-cash flow item if there is no cash inflow or cash outflow as a result of that recognition? For example, we don't spend on depreciation. You cannot tell me that you removed 1 million from your bank. There was a loss of 1 million in your bank. And if I ask you, this 1 million, Where did it go to? You tell me that I used to pay for depreciation. No. Depreciation is an expense, yes, but we don't spend on. So non-cash flow incomes are incomes that we don't receive money from them. Non-cash flow expenses are expenses that we don't spend on. For example, you don't spend on impairment. You don't spend on depreciation. When you are allowed a discount, there is no money you pay to those people that you have allowed discount. When you are receiving a discount, there is no money you receive. Yet, when you receive a discount, it's an income. So let's move forward. So please come again on issue of share bonus or undervalued. We will come to it. There is an example we want to do, which I think has a bonus, if you read the question. So if you didn't read, if you read the question, you know it is ahead. So now there are some few notes that I want you to put down, just some 3 points or so. So what should you do in note the following? So in the consolidated, I want you to note the following. Note the following. There are really no much notes on consolidation. Number one, aggregate what? Cash flows from the three components. If you have been given cash flow statement of two companies, you just need to add them. But in most cases, you are not given the cash flows. You are given the income statement and statement of financial position. But if you have been given cash flows, you just add them together. To aggregate, okay, let me avoid using standard words. Let me use words that we can easily. What is that? Add up. That is to aggregate. Add up cash flows from the three components of operating, investing, and financing activities. So these are just some 4 or so points, activities. So that is the first point I want us to learn. The second point that I want us to learn, so you need to prepare individual cash flows if they have not been prepared, and then you consolidate. So if you have been given separate, financial statements of parent, subsidiary, and associate, consolidate the financial statements, then prepare one cash flow from the consolidated income statement and statement of financial position. That is the second point I'm trying to make. What am I saying? If given separate financial statements, but this is very rare. I see this common in AFR. You will meet it next semester if you pass this. You will meet it in AFR. But just in case, sometimes the examiner is unpredictable. So just in case it is asked, if given separate financial statements of parent, subsidiary, and associate, consolidate the financial statements. You know how to do consolidation from the topic consolidation. That is, and then prepare one cash flow statement from the consolidated financial statements. That is income statement and that. So that is the second point. The third point that maybe I want you to also learn, adjust for effects of intercompany sales. Adjust for effects of intercompany sales. But this one, I don't really need to explain it, because once you have prepared consolidated income statement and consolidated, what do we call it? Consolidated statement of financial position. By the time you are preparing, you have already made the adjustments. What are intercompany sales? Sales and realized profits and cost of sales. Remember, you deduct them from sales, cost of sales, and gross profit. So once you have prepared consolidated income statement and consolidated statement of financial position and it has balanced, point number 3 is not necessary. Point number 3 is not necessary. Point number 4. Point number 4. This is important. Account for dividends paid by the parent. Account for dividends paid by the parent, and also to let me write in full. Some people may confuse. Non-controlling, I wanted to write NCI. Non-controlling interest. This is the first important point. Account for dividends paid by the parent and also to non-controlling interests under either operating activities or financing activities. Remember, I said you can put it anywhere. The standard allows you. So, but the point is, account for what? Dividends paid. Account for dividends paid by the parent, or to what? Non-controlling interests under either operating activities or financing activities. The point is, be consistent. So if you decide that it is operating activity, ensure that every year, because remember, we are not teaching you to pass exams. Suppose you are working for a company that has got subsidiaries. That is what we are learning. Be consistent. If you do it year 1 like that, year 2, year 3, year 4, year 5, you be consolidating it that way. If it is operating activities, every year it must be operating activities. If it is financing activities, every year it must be financing activities. By the way, most people put it under financing activities. I don't have a problem with that. Many people put it under financing activities. Point number 5. Dividends received. Dividends received from associate. You know, these are terms used in consolidation. We are preparing consolidated cash flow, statement of cash flow. So dividends received from associate are put in investing activities. They are put in investing activities. Those are the only points I wanted us to learn, especially the last 2 points. Please take note of the last 2 points. So if these last 2 are the most important, take note of those last 2 points. I can even put them in bold. Okay. I'm just giving you time to absorb 30 seconds and then we move on. Now for the next 1 hour, 30 minutes, I want us to look at I'm saying in exams, you should do it in 40 minutes. Don't take more than 40 minutes to do this question. But because I'm explaining everything I do, that is why I take double of the time. I take more time because I'm explaining. But in exams, take half of the time I've taken because you'll not be explaining to anybody in exams. So let us look at an example. So example, we said it was December 2020. It was question number, I think question number 4. If it is not 4, we'll correct it. So December 2020, question number 4. So workings will be in Excel sheet. So that when you are revising the slides, you just know when you reach that slides, you go to the Excel sheet. So let's go to this question. And I told you to read it yesterday. I hope you read it. Where is it? Yeah. So it is question 4, part B. Part A is on conceptual framework. Part A is on conceptual framework. So part B, Mayange Group has provided you with the following consolidated financial statements for the year ended 31st December 2019. So our year is ended 31st December 2019. Our year is ended 31st December 2019. So revenue is 15. We are working in millions. Remember, we are working in millions. Revenue is 1528. Cost of sales is given. Gross profit, distribution, administration, finance. Okay, we have finance costs. Remember, finance costs are also called interest charges. And then take note of the other item that is not in separate financial statements. Profit share from investment in associate. Profit share. My voice is very clear. The person called you, okay. If you are using my voice, I think it's very clear. I'm listening to myself. Okay, thank you. I think I'm clear. Work on your gadget. So we have finance costs, profit share. So take note of profit share from investment in associate. It is a new item. It is a new item that was not there before. So next we go profit before tax, income tax expense, profit for the year. Take note of what profit goes to the parent. The profit that goes to the parent is 232. 232. Attributable to non-controlling interest is 16. Attributable to non-controlling interest is 16. So let's look at statement of financial position. Statement of financial position. So in this, can somebody help that person who is disturbing us, please? Please don't type in the chat. If there is no voice, the problem is you. Can somebody help him? Okay, so we are non-current assets. Let's analyze these non-current assets. There is PPE. There is intangible assets. So we have both tangible and intangible. Take note of that. There is also investment in associate company, which means this consolidation had both parent, subsidiary, and associate. Had both parent, subsidiary, and associate. So investment in associate company. Other long-term investments. Other long-term investments, current assets, inventory, trade receivables. There is also short-term investments. Short-term investments are normally current assets. Let us continue. Cash and bank balance. So remember, there is no opening cash. So if there is no opening cash, you check whether there is an overdraft. You check whether there is an overdraft. Overdraft is always negative when you are accounting for it. So closing cash is 28, but there is no opening cash. Equity and liabilities. Ordinary shares of 10 Rwandese francs each. Ignore what is written in pen. That is the person who gave me the paper had written in exams that way. So retained earnings. Next, share premium, revaluation reserve on PPE. And you have also been given reserve on long-term investments. So note that there are two reserves. There is a reserve on PPE and there is also a reserve on investments. Non-controlling interest is also provided. You can see non-controlling interest. It has also changed between the 2 years. Non-current liabilities, they are quite a number. There is 10% loan notes, bank loan, and deferred tax. I'm passing through everything so that it isn't my workings. So when I'm referring to workings, I'll try to remember what I passed through. So total non-current liabilities, we have trade payables, we have bank loan, we have accrued interest. So when calculating the interest paid, remember there is accrued interest, opening and closing. We have bank overdraft at the beginning of the year. Remember, there was no cash here. So opening cash will be negative. Opening cash in the statement, that is cash and cash equivalent at the beginning of the year, it will be 46 negative. You will not add, you will deduct it because an overdraft is a negative cash. So you will deduct instead of adding. So at the end where you have got the increase in cash and cash equivalent, instead of adding cash and cash equivalent at the beginning of the year, you will less cash and cash equivalent at the end of the year. Because it's at the beginning of the year, because it is an overdraft. Overdraft is a negative amount in our bank account. And then there is current tax. So remember in tax, there is both deferred tax. Check on this. There is deferred tax and there is current tax. So when we are calculating the income tax, remind me so that I don't forget. Remind me to account for current and deferred. Many people forget about the deferred. So you combine current plus deferred when calculating income tax. Additional information. The other long-term investments are measured at fair value. So you saw the long-term investments in the non-current assets. The other long-term investments are measured at fair value through other comprehensive income, while short-term investments, which we saw as current assets, are measured at fair value through the profit and loss. So long-term investments go to comprehensive income, that is other incomes. But short-term investments, they go to the normal income statement through the profit and loss. There was no gain or loss. That statement is important. There was no gain or loss on short-term investment. So don't have any working for profit or loss on short-term investments. On short-term investment during the year, and these can be sold at any time. Next, during the year ended 31st December 2019, the parent company acquired some equipment for 100 million. So do you see our workings in investment activities is very easy because you have already been told how much was spent to acquire equipment. So you will just say under investing activities, purchase of equipment, 100 million negative. Under investing activities, purchase of cash paid on purchase of equipment, 100 million. So we continue. The parent company made an upward revaluation on its land and building. By how much? 80 million. Again, on revaluation reserve, on land and building, you don't need to calculate it the way we were calculating yesterday. The difference between opening and closing, you have been told it is already 80 million. Remember, you always add it to the PPE. But here it is now to the land and building. You add it on the debit side. Opening balance in the PPE account, opening balance, and then remember to add revaluation. Okay? Depreciation expenses included in cost of sale. Okay, here is where somebody asked me, I had forgotten what was asked. I was asked a question there. Depreciation expenses included in cost of sales for the year is how much? 128. So there will be no working on depreciation. There will be no working on provision for depreciation because it is given. Yesterday, we were having a working of provision for depreciation, if you remember, because the depreciation was not given in the income statement. But here you have already been told the depreciation, which we used to calculate, has already been given. It's supposed to be 128 million. Remember, we are working in millions. So that examiner just forgot. 128, the word million is missing. The following are the details of intangible assets. So remember, intangible assets, let's check here. Intangible assets increased from 120 to 260. They increased from 120 to 260, intangible assets. Okay. So the following are details of intangible assets. So there are three intangible assets. There is goodwill, there is patents, and there is development costs. Now, IAS 38, which we are yet to cover, IAS 38 intangible assets classifies intangible assets into three groups. There is goodwill, there is research and development, and there are other intangible assets. There is other intangible assets. So IAS 38 classifies intangible assets into three. Goodwill, number one. Number two, research and development. And number three, other intangible assets. So goodwill is a classification of intangible assets. Patents falls under category other intangible assets. Development costs falls under the category research and development. So all research costs should be expensed. We will see that in the standard. All research costs should be expensed, but development costs should be capitalized. Development costs should be capitalized if it meets a certain criteria. I normally abbreviate it as a pirate criteria, but we will learn it when we reach there. Development costs should be, all development costs should be expensed unless they meet the pirate criteria. The abbreviation is pirate. P stands for probable, I stands for intention, management, intention, etc. We will see that. So there is the total. So you see this total of 260 and this 120. I hope everyone is seeing it. This total of 260, it is a breakdown of these closing balances. This total of 120 is a breakdown of these opening balances. And if you go to the balance sheet, it is true. It is 260 and 120. So that additional information is very good. So next, development cost, this one here, 164 and 10. Opening is 10, closing is 164. So you are being told development costs incurred and capitalized during the year 31st December equals to how much? 200 million. What does that mean? Development cost that was acquired. To capitalize is to bring it in. That was purchased. That was what? Purchased or was developed. The amount we spent on development is 200 million. That is a cash outflow. So it is under investing activities, 200 million. It is given. Now, this information here, we will use it to test whether there is any impairment or not. To test whether there is any impairment or not. Remember, we had already covered impairment of assets in IAS. Which IAS was that? IAS 36. Yes, IAS, is it IAS 36? Yes, IAS 36. We have already covered IAS 36. So we will test for impairment here. Next, number 5. On 1st January, that is beginning of the year, on 1st January 2019, the parent company made a bonus. So the person who asked me the question on bonus, there is something here on bonus. On 1st January 2019, the parent company made a bonus issue of 1 share for every 10 ordinary shares held at 31st December 2018. So we gave a bonus of 1 share for every what? 10, for every 10 ordinary shares held at the beginning of the year, at 31st December 2018. The bonus was financed from revaluation what? Reserve. Of course, bonus is, there is no cash inflow. So what you do, please understand me here, so that when I start working, I'll not be explaining it again. Let's check here. Do we see ordinary shares at the beginning of the year is 200 million? 200 million. Ordinary shares at the end of the year is 300 million. So which means there was new issue of shares of 100 million, if you can see from here. The difference between 200 and 300. Now, out of this new issue of shares of 100 million, there is also bonus in it. So there is 100 million that if there was no bonus, please understand me, if there was no additional information on bonus, cash received from issue of shares could have been 200, you minus from 300, that is 100 million. And then in the premium, 40 to 140, that is 100. So 100 plus 100 is how much? 200 million. So if there was no bonus, it could have been 200 million as a financing activity. I'm repeating. If there was no bonus, the cash received from issue of shares could have been the difference in share capital and also share premium. So 100 million in share capital, 100 million in share premium. But if there is a bonus, this question was asked, you deduct the bonus from share capital. You deduct it because it has increased the share capital, but there is no cash received. So the difference between opening share capital and closing share capital is 100 million. You find out how much is the bonus and you reduce the 100 million by the amount of the bonus. That one, I don't even need to do complicated calculations. Let's see the way I'm treating it. Can you just see this? Let us read this a second so that you see how I treat it. Oh, this person who did these exams was a good student. I'm seeing he was making sense. Okay, on 1st January 2019, the parent company made a bonus issue of 1 share for every what? 10 ordinary shares held. So the bonus issue was 1 share for every what? 10. So bonus is normally issued at nominal price. So 1 for every 10. So let's look at here. At the beginning of the year, remember it was at what date? Check the date, on 1st January 2019. So I go to the beginning of the year share capital. Beginning of the year share capital, that is 200 million. 200 million is the value. If I want to find the number of shares, I take 200 million, I divide by 10 because each share had a nominal value of 10. So 200 million divided by 10, that gives me 20 million. Yes, this person was right. It gives me 20 million shares. So this was a good student who did that exams. So it gives you 20 million shares. Now, what is the rule? We have 20 million shares. It is 200 million divided by 10. 20 million shares. What is the rule? 1 bonus for every 10 shares you have. So you take 20 million, you divide by 10, that gives you 2 million shares. 2 million shares, bonus shares, because it is 1 for every 10 shares. So you take 20 million, divide 20 million shares, divide by 10 times 1. That gives you 2 million shares. And then you multiply by 10 price. The value of the bonus is 10. The value of the bonus is 10. So 2 million shares times 10 gives you again 20 million. 20 million. So you take the difference between 300 million and 200 million, that is 100 million. You remove the bonus issue of 20 million. So what are we left with? We are left with 80 million here. 80 million and then plus 100 million there. So cash received from issue of shares is 180 million. I'll repeat it when I start doing the question. I just wanted to explain it. So cash received from issue of shares is 180 million. I think we are done. The group made a transfer of 4 million from revaluation reserve to the retained earnings. So to the retained profits. So remember, retained profits will increase by how much? Retained profits will increase by 4 million. Will increase by 4 million. Having said that, let us look at the required. Prepare Mayange Group statement of cash flow for the year ended 31st December 2019 in conformity with International Accounting Standards IS7. Hint, use indirect method. So that is just a guide. Use indirect method. I have 1 hour, 10 minutes to do the question. I hope I'll manage my time well. So we have already read the question. I don't need to read it again. Remember, I said when you want to tackle any statement of cash flow question, what do? You start by posting the first page. The first page you use for the cash flow statement. So what will we have? Mayange, is it called Mayange? Mayange Group statement of cash flow for the year ended 31st December 2019. For the year ended 31st December 2019. Remember, we are working in millions. We are working in millions. Now, what did I say? The first thing you do, even if you know or you don't know, remember you start with operating. Please always have this practice in exam activities. Operating activities. Whether you know or you don't know, just start with operating activities. And what do you start with? Cash generated from what? Operations. In all cases, that will be working one, because there is indirect method or even direct method to be used. And then you less, what do you less? Interest paid, whatever working it will be, less income tax paid, you less dividends paid by the parent, dividends, the normal dividends, I call it dividends paid by what? Parent. If we are assuming the other members were not there, even if the other members were not there, if there was no group, the parent could have still paid dividends to other people, to other shareholders. And then because there was a group, there is also dividends paid to NCI. Remember, this was the last point. Was it the last point? The last point that I put in consolidation. Now, somebody is asking which method are we using? Direct or indirect? What did the question ask? Please read the question. What did the question ask you to use? Thank you, Rebecca. So read the question. Read the question. And then what will we get? So maybe what will we get? Net cash I don't know whether it is from financing or investing activities. And then I will go to investing activities. Investing activities. Of course, I saw there was purchase of, was it purchase of PPE? There was PPE that was purchased. Purchase of PPE. We read it. That is the importance of reading additional information. Now, if there is any disposal of PPE, you also include it. If it is not there, you don't include it. So there was, look at here, there was other long-term investments. Do you see there is an increase in long-term investments? So that is, there is purchase of long-term investment. So purchase of long-term investments. Please let me not go back in what I explained yesterday. I think indirect is starting by profit before tax. I explained what I'm doing yesterday. I hope you were there yesterday in class. I hope you were there yesterday in class because you are returning us back. So purchase of long-term investments, purchase of, please note that this working covers what you are asking, but I hope you attended class yesterday. If you did not, I cannot help you there. So purchase of long-term investments. Next, so purchase of long-term investments. What else? If there is any, okay, I can leave some spaces because I'm not sure. Maybe let me leave 3 spaces because I'm not sure of other transactions. As we tackle them, let me leave some spaces there. Maybe 3 spaces. What do we get? Net cash. Please, let's minimize our questions. I've not even started solving the question. What about intangible assets? That is why I've left spaces, please. That is why I've left spaces. That is why I've left spaces. Net cash. I know that I've just left spaces. So next, we have financing activities. Now, financing activities, there was issue of shares. And I had already even explained that it is 180. Was it 181? It was 200 million minus bonus of 20 million. It was 180. Issue of shares. So issue of shares, this one we even already know. This one I'm very confident because we have already even calculated it. I only need to redo the calculation, 180 million. Next, loans. Did we have loans? Non-current liabilities. Yeah, there is a loan. You can see the first loan has increased. So there is a borrowed loan. Bank loan has reduced. So there are 2 loans. One has increased, the other has decreased. So cash received from what? Borrowed loan. Borrowed loan. Next, we can even post that. Okay, cash received. Is it called loan notes so that I don't mix it? From loan notes, from 10%, 10% loan note. Next, repayment of what? Bank loan. Repayment of bank loan. So those are the 3 items that we need there. So whatever we get is called net cash from whatever. Net cash, either increase or from or used. And then what do you get after that? You get either increase or decrease. I don't know what it is, but let me just put increase. Increase. If it is different, I'll change in cash and cash equivalent. Increase in cash and cash equivalent. And then remember, let's check here. Let's check in the bank. I'm looking for the bank. Opening cash was a negative. Remember, opening cash was an OD. OD of how much? 46. So you remember that OD was, overdraft was 46. So overdraft is negative. So here you will less, but in other questions you normally add. So you will less what? You will less cash and cash equivalent. Why do we less? Because it is an overdraft. Remember, it is an overdraft. Overdraft. That is why we less. So less because it's an overdraft. So it was how much? 46. So we will less 46. Remember, we will less 46. So if our answer is right, this is what I always tell you. In order to even confuse the marker, the answer here is cash and cash equivalent. This is what I advise you to do in exams. Equivalent at the end of the period year. Now you just go and pick it and post it. Look at this. Cash and cash equivalent at the end is how much? 28. So it is safe just to write it so that if the marker is not keen, he sees that you are correct. But you are correct without doing any working. So if our answer is correct, there we must get 28. What does it tell you? You even know what is there. What should be there? You automatically even know it. So what should be there? It will be this plus that. So it is 74. Even without calculating it, you know it's 74 because this is an overdraft that is deducted to get you 28. So I always advise you to play with the mind of the examiner by just doing something like that. You will be safe if you do something like that. So that if the examiner is not keen, you will be in a position to earn some extra marks there without even struggling in your workings. So let's go to what somebody was asking you. Think what you are thinking is right, but in the wrong place. Okay, let's start our workings. What is our working one? So working one is how to get cash generated from what? Operations. Using which method? Using indirect method. The person who was asking me, this is where I'm accounting for it. Using indirect method. Cash generated from operations using indirect method. Cash generated from operations using indirect method. So I'll remember we are working in millions. We are working in millions. How did you find shares issue of 180? I just have already calculated it, but I'll recalculate it again. Please always be keen when we are calculating. We had already calculated. I think indirect is starting with profit. Okay, I've already answered you that. That one will be used to calculate cash. Yes, thank you, Alphonse. How did you find shares? Okay, somebody has already answered you there. So let's start with this. What do we start with? Profit before tax. Profit before tax. And then, of course, you know other items that you account for even before. You add back what? Add back finance costs. Finance costs are also called, you add back depreciation, and also you add back any impairment of intangible assets, in this case, impairment of intangible assets. And our intangible assets were, what were they? Goodwill, patents, and development costs. Goodwill, patents, and development costs. That is impairment of goodwill, patents, and development costs. Or let me just call it development. You know what we mean by that. So we have, that is impairment. Next, if there is any, there was profit from investment in associate. So profit is a non-cash flow. So you do what? You less profit. Please take note of that. This is what we are adding from. This is what we are including. Let me not use the word adding. Profit from investment in associate, because there was investment in associate. If it is a profit, you less it because it is an non-cash flow. If it is a loss, you add it. Now, if there is any other loss, because there is intangible assets, etc., I don't know what we will meet when we solve. So, and then if there is any loss, any other loss, you add. Next, inventories. Can somebody help me in inventories? Was it an increase or decrease? Inventories. Look at inventories from 376 to 568. Is it an increase or a decrease? It is an increase. Receivables 272 to 396. It is an increase. Let us look for payables. Where is payables? Where payables is also an increase. So everything is an increase. So let me recon. Everything is an increase. So if everything is an increase, so increase in inventory, you less. You know the rule now. Increase in what? Inventory, you less. Less again, increase in receivables. Okay. Increase in receivables. Add. Payables is the opposite of receivables. Add what? Increase in payables. So the answer you get is what we call cash generated from operations. The person who was asking me that question, that is where we get the answer. Cash generated from operations. And then automatically you will go to working two. Now, let us post, so that we get these, let us post anything that does not require working. Any item that does not require an additional working, let us post it. Profit before tax does not require working. So let's look for profit before tax. What is profit before tax? Profit before tax is 356. You can all see this 356. So profit before tax is 356. I hope we are together. Finance cost. Finance cost is 12. I hope we are all seeing finance cost is 12. This finance cost, you add it back, 12. 12, add back 12. Depreciation. This time we are very lucky we are not calculating it. I read it somewhere. Depreciation, where was it? Somebody to help me? You know, sometimes. Okay, additional information 3. Depreciation expenses in the cost of sales of the year ended 31st December was 128. So depreciation is 128. So add back 128. So this one will require working. This one will require working. Where have we reached? Working. Working 2. That will be working 2. This will be working 3. This will be working 4. So we'll be having those workings. Okay, fine. So working 2, working 3, working 4. We'll have them there to test for impairment. If it is not there, we remove it. Now, profit from investment in associate, this is already given. Profit from investment in associate is 8. Profit from investment in associate is 8. So if it is a loss, we add. If it is a profit, we less. So 8, we will less 8. Now, loss on disposal of plant, we were also given. That is why it is important to read additional information. I read it somewhere. Yeah, here. During the year ended 31st December 2019, the parent company acquired some equipment for 100 million. This one goes to investing activities. The parent company made an upward revaluation on its land and building for 80 million. That is revaluation during the year. In addition, items of plant were sold at a loss of 20 million. Items of plant were sold at a loss of 20 million. So items of plant were sold at a loss. So this one, it is loss of what? Plant. Loss of plant at a loss of 20 million. Now, increase in inventory, this one we can get. We don't need a working on that. We can just do it in the page. Inventory, 568 minus 376. 568 minus 376. 568. 568 minus 376. So we will get whatever we get there. Receivables. Receivables. 396 minus 272. 396 minus 272. Okay, minus 272. Payables is, if there is a correction we will make, don't worry about that. Payables, 462 minus 372. 462 minus 372. 462 minus 372. So let's get those values. So that one is equals to 568 minus 376. We get that 192. This one is 396 minus 272. I hope I'm right there. And this other one is 462 minus 372.90. So what we are remaining with actually, so show me 8 on the profit in the equation. Okay. Here. Profit share from investment in associate is 8. Profit share from investment in associate is 8. It was added to get the profit. So because profit is a non-cash flow, you less it. If it is a loss, it could have been deducted. So you correct it by if it is a loss, you add it. Okay. Let's continue, please. So let's go to workings. And in our workings, let me go to what we did yesterday so that I save time. What we did yesterday, I'm just picking a T account. I'm just picking a T account so that we save time. So what we did yesterday, I'm just picking a T account. So we have that so that we save a lot. Okay. I'm just trying to, also this one is not alone. So I've just give me a minute, please. A minute. So that I don't repeat myself a lot. Just give me a minute so that I post these things. Let's pray there will not be that many, so that when I start calculation, I just save time. And maybe the last one. Somebody also wants to ask me how we prepare T account. So sir, I don't understand the reason of subtracting profit from. You don't understand the reason for subtracting profit. Profit is a non-cash flow. Profit is a non-cash flow. Remember, we are using indirect method. We want to know how much cash the business has. Now, profit is not cash. Profit is not cash. So we started with profit before tax, and you work backwards and make any adjustment that is a non-cash flow. You make, for example, depreciation is a non-cash flow. Depreciation is normally deducted as an expense. Because it is deducted as an expense to get profit, you add it back. Investment income is always added to get the profit. You less it. If it is profit is normally profit from associates increases our profit before tax. Because it increases, yet it is a non-cash flow, you less it. Losses from associates reduce our profits, yet losses are also non-cash flow. So if it's a loss, what do? You add it back. You add it back. So I hope you were there yesterday when we started, because those are the things we were explaining yesterday. It is not fair to ask it at the point of consolidation. No, you should have asked it yesterday. So what was our working to? Goodwill. So we want to test on working to if there is any impairment of goodwill. If there is any impairment of goodwill. Okay, sorry, I was talking to somebody. So impairment of goodwill. So if there is any impairment, you account for it in the same way as depreciation. So impairment of what? Goodwill. The next one is impairment of patents. The next one is we are testing for impairment I'm confusing you. Let me not call them. Let me just call it goodwill account because we will know whether there is impairment. This one, let's call it patents instead of impairment. Patents, because we are testing, it may not be there. So next, this one we call development costs. Yes, we add the profit, we don't less. So you add the profit. So goodwill, now please understand, goodwill is an intangible asset. How do we PPE? Intangible asset is a non-current asset. How do we account for non-current assets? How do we account for non-current assets? If there is any opening balance, you put it there. Balance brought down. Balance carried down. And yeah, we were given this. Remember, kindly remember, here we were just given total intangible assets, but we need the breakdown. The breakdown of the 260 and 120 was given in this table here, 260 and 120. But goodwill, opening is 80, closing is 72. Opening is 80, closing is 72. 80 and 72. 80 and 72. So opening is 80, closing is 72. There is no additional information that tells you there was another goodwill, another company that was acquired with a goodwill. No. So in this case, the highest figure is 80. 80. You bring the 80 also there. You also bring it there. Now, please note, if there was any acquisition, I could not have called this impairment. I could have just called it what? Goodwill. If there was any acquisition, we could have, this side, this 72 could have been more than 80. For example, if the closing balance is 100, 100 will be here. 100 will be here. There will be acquisition of 20. I hope we are together. But because the credit side is more, it means there was impairment, depreciation, impairment of what? Goodwill. Impairment of goodwill. Am I confusing you? No. In this case, this amount was a net book value. Net book value. Net book value. Because it is in the balance sheet. It is in the balance sheet, net book value. This amount is also a net book value. So if we use net book values, if we use net book values, you must show depreciation. Depreciation is the equivalent of impairment in here. You must show that, okay? So this, what is a balancing figure? Somebody to help me? Impairment of goodwill is a balancing what? Figure. Balancing figure. So balancing figure there, the advantage of cash flows is if we are wrong, it will not balance. So sometimes I look at the comments people give me in the private chat if I was to follow them, there is no cash flow that will ever balance. So here is opening balance is 80, closing balance is 20. So opening total is more than the credit side. So there is impairment. That is working 2. Goodwill working 2, there is impairment. So let me just call it goodwill there. Working 2 is on goodwill. So goodwill, so it is 8. I can go and post it. So this is how much? It is 8. We repeat the same for patterns. Now you know the trend. Patterns, opening, balance, brought down, balance, carried down. So let's look at balance brought down for patterns. Patterns was the second one. Patterns, opening is 30. Closing is 24. Opening is 30. Closing is 24. Opening is 30. Closing is 24. Again, if closing was more than opening, there was acquisition. There could have been acquisition. If closing was more, there could have been acquisition. There could have been acquisition. There could have been acquisition. So here, what will it be? Impairment of patterns. Remember, according to IAS 38, which we have not yet covered, we don't call it amortization. We call it impairment. From 1st April the year 2000, I'm quoting a standard, by the way. I'm quoting a standard. From 1st April 2004, we stopped amortization of intangible assets. Instead of amortizing, every year we review for impairment. So that is what we are reviewing. There is impairment. So according to IAS 38, from 1st April the year 2004, we had stopped amortization of intangible assets. So every year, what we do, we just review for impairment. Balancing figure. So I hope also you people, by the time you are doing exams, you would have mastered standards and you will be singing them. So that you know contents of every standard. So is equals to that. Now, let's go to the last one. Development cost. Again, balance brought down. We have balance carried down. So development cost, sorry, not patterns. Development cost is 10 and 164. 10 and 164. 10 and 164. So we have 10 and we have 164. But remember, there is something we were told here. The next statement. Development costs incurred and capitalized during the year ended 31st December 2019 equals to 200 million. So there was acquisition. Let me call it purchase in a word that everyone, but let me call it purchase. Purchase or development, or I cannot use development of development costs. So let me call it purchase of development. How much we incurred, how much cost? Purchase, I know the best word to use here, cost incurred in development. Cost incurred in development. Cost incurred, I think that should be the best. Incurred, because we don't purchase development, we develop. We don't purchase. Cost incurred in development is the best word to use. Cost incurred in development. So you can check here, it is 10 plus 200, it gives you 210. So this should also be 210. And then The balancing figure will be the impairment because they are not the same. Impairment of what? Development cost. So impairment of development cost is also a balancing figure. So don't forget this 200. Don't forget this 200 you are given in the question. So this one is equals to 210 minus 164. It gives you 46. So if you want to know that the workings are right, just a second, please. If you want to know that your workings are right, you do this. Will it really test what I want to do? If you want to know your workings is right, the first impairment is 8. 8 plus the second impairment is 6. The third impairment is 46. So those three impairment, 46. So how much does that give you? 8 plus 6 plus 46. How much impairment is? 60. 60. So the impairment, the total impairment is 60. So we go back here. We go back here in intangible assets. Look at here. 260 minus 120. If I want to test what I've done is right. 260 intangible. Remember, goodwill, patents, and development costs are intangible assets. So 260 minus 120, that is how much? 140. I hope we are together. 260 minus 120 is 140. We acquired, the acquisition was 200. So remember the answer there is 140. The acquisition was 200 million. This one here, 200 million. I'm just doing that to test. It doesn't add you any mark. So acquisition was 200 million minus impairment of 60. Minus impairment of 60. How much does it give you? 140. I hope we are together. We acquired goods worth 200 million. The total impairment was 60. If you get the acquired minus impairment is 140. And that 140 where is it? Please, let's not write in your screen. I always give you an option to share so that in case you have something to share, you are to share. But some people are now writing on the screen. You are making our screen dirty. So what you are saying is you are even making me to forget what I was saying. So 260 minus 120 is 140. That is how that 140. Those are tests that we always just do to confirm that our progress is good. So we are already done with the first part. So what is the total of our working one? Oh, I've not posted this. Development is 46. Now we are done with everything here. So we are in a position to get, please let's be careful here. Profit, if I say add, you add. If I say less, you less. So that is what we are doing there, is 356 plus 12 plus 128 plus 8 plus 6 plus 46 minus 8 plus 20 minus 192 minus 124 plus 90. How much does it give you? 342. So the person who started asking me that question, this is what you start with profit, yes, but you end with cash generated from operations, and that is what you take to your workings. So working one is 342. So you can bring it here. So working one is 342. We are done with working 1. Hey, I'm remaining with 24 minutes to finish. So let me try to finish within 24 minutes. The acquisition is only related to development? Yes, it is only related to development. It is given in the question. You have the question in the group. Please read the question that is in the group instead of going back. Development costs incurred and capitalized during the year equal to 200 million. The acquisition is only related to development costs. It is given in the question. Now, we are done with that. So next we are going to interest paid, income tax paid, and dividends. So those are what we are: interest, income tax, and dividends. So working, I've even forgotten. So working 2 was goodwill. Working 3 was patents. Working 4 was development costs. We'll go to working 5. Working 5 is interest paid. Working 5 is interest paid. Interest paid. Interest paid is our working 5. Interest paid. Remember, interest paid is an expense. Interest, which is an expense. Account. Interest is an expense. How do we post expenses? Accrued expenses are posted on the credit side: opening, closing, balance carried. Once you remember the format, it is very easy to practice. And then the amount in the income statement, that is the interest in the income statement, you also post it. So let's go for it. Opening interest, closing interest, and the one in the income statement. So opening interest, current liabilities, accrued 2 and 6. 2, 6. 2 and 6. So we have 2 and we have 6. So in the income statement, do we have interest, finance costs? Finance cost is 12. So we have, you can all see this 12 here. So it is 12. Where is it? 12. The only problem with ICPA is even past papers don't have answers. So when we do this way, please save these Excels, because I'm also doing them for the first time. Once you have that, save it somewhere. Those are answers that we are generating for past papers. So those are answers we are generating for past papers, because ICPA does not provide answers. So it's important to save this work somewhere. So you can see 14 here. So what is the cash paid? Cash paid is balancing figure. Balancing what? Figure. So our balancing figure is equals to 14 minus 6. How much is that? 8. This question had got very many 8s that if you are not very careful, it can confuse you. Working 5 is also 8. So you can see there are very many 8s in this question. So don't get confused. That is why it's important to write the working number. That is the importance of writing the working number so that you don't get confused. So working, so that is working 8. Sorry, not working 8, working 5, this one. So we are done with that. Next, we go to working 6. Working 6 is income tax. Working 6 is income tax. Before I forget, there were 2 income tax. You remember? There were 2 income tax. Balance brought down. Remember, there was deferred plus what? Current tax. Current tax. Deferred plus current tax. So don't forget about that. There was deferred plus current. So don't forget about that. So I'll not have only one figure there. I'll have two. Balance carried down. So let's go for opening balance so that we don't mix them. Opening balance, deferred tax was 56. I hope everyone is seeing 56. Current tax was 64. So 56 plus 64. 56 plus 64. 56 plus, I'm just repeating so that I remember. 56 plus 64. I hope I'm right there. 56 plus 64, that gives you 56 plus 64. What does it give you? 120. I've put it into bracket here so that you know how 120 was got, so that you don't struggle to look for it. Let's go for closing. Closing deferred was 124. 124 plus 52. 124 plus 52. 124 plus 52. So 124 plus 52, 124 plus 52. So what does it give you? 176. Now, in the income statement, the amount in the income statement, what was the tax in the income tax statement? Tax paid in the income statement. In the income statement, this is our income statement tax. Were we given tax? Yes, we were given 108. So the tax that we were, it was big, 108. You can see 108 is the tax in the income statement. So in the income statement, where is it? 108. So 108 is an income statement. So which side is more? The credit side. So this plus that. So what does it give us? 228. So that will also be 228. So what is the cash paid? Cash paid, which is a balancing figure, of course, which is a balancing figure. The cash paid is 228 minus 176. We get 52. So the cash paid is 50. The cash paid is 52. So that is working 6 is 52. Working 6 is 52. Working 6 is 52. So slowly we are moving on. Working 6 is, how much is it? 50. Working 6 is 52. Are we still remaining? Okay, yeah. So we are remaining with working 7, dividend by the parent. Working 8, dividend paid to NCI. Dividend by the parent, working 7, working 8, dividend paid to NCI. So working 7, dividend paid by parent. Remember, it is always not there. Always not there. So it gives rise to some working here. I hope by now we are familiar with what I mean. It gives rise to working, because it is not given. Working 8 will be accumulated profits. Remember, accumulated profits are also called retained earnings. Retained earnings. So retained earnings is also there. That is the one that relates to parent. And then Our T's are almost over. So there will be working 9. So that I just do them together. Working 9. What is working 9? Working 9, dividend paid, dividend paid to NCI. So because it's NCI, we will prepare working 10 also. Working 10. Working 10 will be NCI account. NCI account. NCI account. So, okay, so to get those two points, you really needed a lot of workings. So let's try it with dividends paid. The first one, balance. Please let me just write this to save time. Balance brought down, balance carried down, and then of course the value in the income statement. This will be here. What we'll get is cash paid. Is it cash paid? If I'm not wrong, cash paid. Just allow me to take my time there. Balancing figure. So, allow me to take more time there. Just allow me so that we take less time. I'll copy that and I'll come and paste it there. I'll come and paste it there. But that will not be cash paid. I'll also come and paste it there. I'm just doing this so that I save time of typing. I'll paste that there. And also I'll come and pick these. I'll copy that. And also paste it there. So I have whatever I need. So let's just move very fast so that we get this. So dividends, how do you get the dividend paid? You go to the current liabilities. Current liabilities. We didn't have it. So dividends paid is not there in the current liabilities. It is missing in the current liabilities. So because it is missing, let us be together here. Because it is missing, what you do is, if it is missing, it means there was no accrued, which means what was payable is what was paid if it is missing. So that is missing. So which means this other one is also missing. This one is also missing. It is missing. So it even makes the work easier. So let's start with this one. Now we said dividends is never shown in the income statement. Dividends is never shown in the income statement. Therefore, you calculate it. So that is working 8. That is why the working 8 was there, because it is never shown. That is why working 8 is there. So we go to working 8, we look for profits. Profits. Retained earnings. Retained earnings in the balance sheet, 652 and 728. 652 and 728. Where is it? 652 and 728. 652 and 728. Now, profit for the year. So what is profit for the year? Profit for the for the year. For the year. And remember, the one that goes to the parent. Profit for the year, the one that goes to the parent, because this is consolidation. Profit for the year is how much? Somebody? Profit to the year that goes to the parent is 232. So profit for the year is 232. Where is it? Wow, this 232. Profit for the year for parent. Let me write in full. For parent. Profit for the year for what? Parent. The parent share. So the share of the parent. And again, understand there was another additional. Was it in this question? You know, I've read many questions until I saw something that was transferred to there. Something that was transferred to retained earnings. Anybody can help me identify it? I saw some reserve that was transferred to retained earnings. Anybody can identify it? Okay, thank you. I've seen it. Thank you. Additional information? Additional information what? Thank you. 6. So the group made, this one. Thank you for that. That is why it's good to learn together. The group made a transfer of 4 million from revaluation reserve account to retained what? Profits. So retained profits gained. So retained profits gained 4 million. So transfer from what? Revaluation reserve. Transfer from revaluation reserve is 4 million. Is 4 million. So of course this side is more. So 6 plus this plus that. How much does it give you? 888. So this also gives you 888. So the answer we get is dividend payable. Dividend payable. Now this dividend payable, because there was no opening, there was no closing. Because there was no opening, there was no closing, the dividend payable remains the same. So income statement value is equals to this 160. And because there was no opening and closing, what was payable is what was paid. What was payable is what was paid. But if there is an opening balance, what is payable is not what was paid. So here is equals to 160 minus this amount if it is there. So this time, so this is 160. The calculations are a lot. Let me reconfirm something. Working 7. Working 7 is 160. 160. So working 7. Please understand me. These two, you can also put them under financing activity. It doesn't matter, but you must be consistent. So you will find most books put these two figures under financing activities. They are also right. Finally, let's go to dividends paid to NCI. Dividends paid to NCI, non-controlling interest. So dividends paid to NCI, this one will be working 10. Working 10. But because there is no opening balance, the payable will be the same as, so this one we open a NCI account. We open an NCI account. Were we given non-controlling interest? Somebody to help me in the balance sheet? Under equity, it is treated in the same way as retained earnings. So 40 and 54. Non-controlling interest is 40 and 54. 40 and 54. 40 and 54. 40 and 54. Now, income statement profit, share of NCI. Share of NCI. Please note, so that you don't get confused. I know when we do consolidation, sometimes we get confused. Remember here, we took the share of the parent there. The share of the parent. In NCI, we take the share of the profit share of the NCI. So income statement NCI share. Were we given? Were we given? Yes. Attributable to parent is 232. NCI is 16. So attributable to NCI is 16. Pray very hard. This is not tested again. It was tested last year. So, you know, prayers are answered, yeah? Prayers are, just pray that it's only a normal cash flow that is tested. So if it is a normal cash flow, the work becomes easier. So this is 40 plus 16. So that is 56. So this gives you 56. So what is dividends, cash paid? Not really. Dividends, we call it dividends. Dividends payable to NCI. To NCI. It is a balancing figure. Balancing figure. So it's a balancing figure. So balancing figure is 56 minus 54. So it's a very small, all that working is only giving us 2. NCI is 2. So you bring these 2 here. All that working is only giving us an answer of 2. So you will take this, which is missing, plus that is how much? 2. So this is also 2. So the balancing figure is this minus that. So it gives us 2. So working 9 is 2. Working 9 is 2. Working 9 is 2. Working 9 is 2. 2. We have 2 there. What are the charts asking? Okay. You know, sometimes I'm not the setter of exams. So I'm very sorry to those people who sat in December 2020. So that is how life is sometimes. Why can't we say? Okay. So sorry for those who sat. You know, life sometimes you don't. So let's hope, because it was harder last time. We just hope. We hope this time it will be easier. So let's pray that this time your exams will be easier. Now I know why I have many friends here. I now understand. Okay, let's continue. So it is 2. You know, sometimes even as the lecturer, you even look at the question, you wonder, is this doable? So, okay. So this one is cash 342 less 8 less 52 less 160 less 2. What do you get? 120. So what you get is 120 positive. So what is it called? Net cash from operating activities. Net cash from operating activities. Net cash from operating activities. Now, let us move to PPE. Let's do this. Just take 2 minutes to stretch. I don't want to give a break. Just leave your seat for 2 minutes. Just have some stretching. Don't log out. 2 minutes, leave your seat and come back so that we go to investing activities for 10 minutes. Again, financing activities, 10 minutes and we finish. So just stretch, leave your seat, 2 minutes, come back. Don't log out. Don't log out. Just stretch, leave your seat for blood to flow. Just stretch as I also stretch. Okay, I hope you have stretched. So let's continue. Let me hope they will not be as many as I'm posting. So this examiner did not know there was a lockdown in December. So let's let's move on. Working 11. But why am I going and I've still not read? So now, is there any additional information so that we save time? Is there any additional information that told you that there is something that was acquired? Acquisition of investments. If there is any additional information on acquisition of investment, we start by posting those ones. So the other, okay, during the year ended 31st December, I'm just reading additional information. During the year ended 31st December 2019, the parent company acquired some equipment worth 100 million. So acquired some equipment worth 100 million. So worth 100 million. So purchase of, let me be very specific. Purchase of equipment. The purchase of equipment, it does not need working. It is 100 million. Okay, let us continue with the additional information. So we acquired worth 100 million. So during the year, the revaluation was blah, blah, blah. We will come back to that. Revaluation, the items plant was sold at a loss of 20 million. So next, depreciation expenses. I'll come back to that working. Development costs incurred and capitalized during the year was 2019 was 200 million. So acquisition of costs incurred, I'll call it cost paid for development. That is the best way to call it. So cash paid for what? Development costs. We cannot call it purchase because development you are developing inside the company. Development costs. Cash paid for development costs. It is how much? 200 million. Let us continue reading. We see if there is anything we can post directly before we start working. On 1st January 2019, the parent company made a bonus issue of blah, blah. Okay, that one does not affect investing. The group made a transfer of 4 million from revaluation reserve account to the retained earnings. That is not also relevant for this. So with that, we can now prepare the major accounts. So we have posted. So look at this. These two, by the way, these two will not earn you any mark. They will not earn you any mark, but you must post them because there is no working. Workings is where we get marks. So these two, if you don't post them, you will lose marks at the end, but they will not earn you any additional mark because there was no working for it. So if there was no working for it, it doesn't earn you any mark. Now, maybe before I continue, is there anything that was disposed? I saw some disposal somewhere. You know, I've been reading many questions, so I don't know if it was in this question. The other long-term investments are measured at fair value through other comprehensive income, while short-term it is hidden here. While short-term investments are measured at fair value through profit. Short-term investments. Okay, please let's read through these. Short-term investment. There was no gain or loss on short-term investments during the year. And these investments can be sold at any time, of course, during the year. So we go to short-term investments. So short-term investments moved from 40 million to 30 million. It means there was a disposal. In the process of disposing these short-term investments, we earned 10 million. So that is cash received from disposal, 10 million. Cash received from disposal. So you see the importance of leaving that space. Cash received, cash received from disposal of short-term investment. It is 40 million minus 30 million. 40 million minus 30 million. How much is that? Whatever value you get, it is 10 million. So remember, cash received is an addition so that, you know, sometimes by the time I start doing it, I may be tired. So that is to add cash paid is to less purchase of long-term investments is to less disposal of PPE. If it is there, you add What else? Purchase, of course, purchase is less. So we have all that. So we have looked at that. So what is remaining is basically workings on that. So let's look for disposal of PPE, number one. Next, we look for purchase of long-term investments and maybe any other. Dividends received. Yeah, we received, how did I forget this? We received what? Dividends from associate. Do you remember that? We received profits from associate. Therefore, associate also paid dividends. Dividends, I don't know how I forgot that. It could not have worked out. Dividends received from associate. Dividends received from associate. So just be patient with me, please. So we had stopped in working. Working. So we are going to working 11. So just be patient a bit. Cash flows and consolidation take time to explain. So disposal, this will be working 11. This will be working 11. This will be working 12. So that I just move when I'm moving forward. This will be working 13. So I want to look at working 11, disposal of PPE. Working 11, disposal of PPE. Disposal of PPE. Working 11. Working 11, disposal of PPE. Working 11, disposal of PPE, property, plant, and equipment. Disposal of property, plant, and equipment. So in our disposal of property, plant, and equipment, we need to show of course, we open which account? Disposal account. Disposal account. We need to show the cost of the item that was disposed. The cost of the item, oh, we could not have done that fast. But anyway, the cost of the item that was disposed. Now, the depreciation of the item that was disposed. Is it necessary? No, it is not necessary in this question. And next we have loss. We were given loss. You remember that? There was a loss on disposal. Because of that loss is why we knew there was an item that was disposed. Because of this loss. So loss on disposal, hey, I've even forgotten where it was. Where was it? Yeah. In the items of plant were sold at a loss of 20 million. So if it is a loss, it is on the credit side. If it is a profit, it is on the debit side. So this is called, let me be calling it specific name. Disposal of plant. I always like using the specific name. So it is 20 million. There is some missing information there. So disposal of plant, let me see if I can get the cost somewhere. If it is not there, we must work it out. Just give me a second. I'm just reading through the question. Will this question balance? Let's just hope it will balance. Because that, let me skip that working. I go to the next one because there is missing information there. Working 12. Maybe in working 12, we may get the information that is missing there. So working 12, I'll go to maybe Purchase of PP, is it purchase of PPE? Just be patient with me. Patience, patience, patience. Yeah, purchase of working 12 is purchase of long-term investments. Just a second. I'll make long-term purchase of PPE. Did we do any purchase of PPE? Maybe we did it, I don't know. Purchase of PPE. Just a second, please, please, please. Yeah, it's not done. How did we? Oh, I remember why we left it out, because we were already given what was acquired. That is where the point is hidden. Purchase of, now I have understood. Purchase of PPE. We did not calculate it because it was already given. Purchase of PPE. Now, opening balance. Please, let's be attentive here. Balance brought down, but remember, it is not cost. What is given in the balance sheet, that is why it was confusing me, is a net book value. Net book value. What we were using before was cost, but now we have been given the net book value. What is always in the balance sheet is the net book value. Balance carried down. Again, it is a net book. That is why I was really struggling to look for it. Net book value. So now, let's go to the PPE net book values in the balance sheet. In the other questions, you are always being given additional information. But here you are not given. So you pick it from the balance sheet. If you pick it from the balance sheet, it is a net book value. So 732 and 756. Remember, plant is part of PPE. Plant is part of PPE. So 732, where is it? There is really a lot. 732 and 736. Is it 756? I'll reconfirm. 756. Now, you were told there was revaluation. Revaluation we were given as, was it 80? Revaluation, was there any revaluation? Did I see revaluation of 80? Yes. The parent company made an upward revaluation of its land and building by an additional how much? 80 million. By an additional 80 million. So there is revaluation of 80 million. So I know I'm taking a lot of time, but I just want to ensure that the question is doable. 80 million. Now, there was acquisition, purchase of what? Plant during the year. What was the purchase of plant during the year? Was it 100 million? So this question had a lot of workings that if you are not careful, it can confuse you. Purchase, yes. During the year, the parent acquired some equipment for 100 million. That is still PPE. Property, plant, and equipment. So purchase of equipment, not plant. Purchase of equipment. Equipment was 100 million. Yeah, I think I've now cracked it. Now, if you use net book values, remember, this is PPE. PPE, not at cost. At what? Net book value. At net book value. If you use PPE at net book value, you must account for depreciation. If you use at cost, you don't account for depreciation. Now, we were told depreciation for the year was 128 million. I hope you remember, okay, you know I'm very good in mastering. But let me just show you because I read it. 120. Who read it with me? Yes. Depreciation expenses included in the cost of sales was what? 128 million. So depreciation for the year is 128. Depreciation for the year is 128. Now with this, we can get the total. So let me test this first. Plus that, I'm just testing. Let me also test this. I want to see which one is more. Yeah, 912 is more. Okay, so we'll put 912 here. 912 is the figure we'll put there. So 912. So in this case, the balancing figure becomes what was disposed. Disposal. Disposal is the balancing figure. Balancing figure. Disposal is the balancing figure. So what was disposed? 912 minus 128 minus 756 is how much? 28. I'm putting it in red because it is a balancing figure. So that 28 is the cost of the asset that was disposed. So this is what was missing here. So working 12. Working 12. Sorry. Working 12. So working 12 is 28. So 28, we've got that. So we can now close this. That was the information that was missing. Is equals to 28. This one must also be equals to the higher figure, 28. So what will this be? Cash received from disposal. Cash received from what? Disposal. Cash received from disposal. It is working balancing figure. Balancing figure. Sorry for that delay. I was really trying to find out where the cost was. So there it was, where it was hidden. So sorry for that delay. So cash received from disposal. Sorry, what have I done? 28, you know when the mind, okay, minus 20 is 8. It is 8, not 28. So working 11. So that is working 11. Working, did we have it? Yes. So disposal is how much? 8. Working 11. Working 11, working 11. 8. Okay. Finally, we have in the investing activities, I've taken more than 10 minutes that I had promised you. We have purchase of long-term investments. Purchase of long-term investments. This one we can put purchase of long-term investments. This one we can, I think we can get it directly. It is not, of course. Do we have long-term investments that were purchased? Purchase of long-term investments. Let me see. Let me see. Do you see long-term investment somewhere? You know, I'm confusing this with another question. So long-term investment, yeah, there is long-term investment. You can see it here. 60 to 80. Which means there was some movement that took place. There was some movement that took place. So I must work on that. So it will be not working because I've already interfered with the workings. It will be working 13, if I'm not wrong. Working 13 because I've already done 12 something else. Working 13. So purchase of long-term investments. Working 13. There is a purchase because you can see the difference. So purchase working 13 Where is it? Working 13 is here. Please just be patient with me. I'm almost finishing. Working 13, purchase of long-term investments. Purchase of long-term investments. So under the purchase of long-term investments, there was the opening balance. Balance brought down. There was balance carried down. Let us go and pick it. And then here. So long-term investments again. Long-term investments, you can see it here. 60 to 80. 60 to 80. 60 to 80. Working 13, 60 to 80. I also saw something on revaluation. Revaluation of long-term investment. Anybody who can trace it? Revaluation of long-term investment. I saw it somewhere. Revaluation. It is where? I'm seeing somebody's writing 10. Where is it? I saw it somewhere. Somebody to help me, because if we miss it, it will mess us up. So how did you get 10? The person who wrote 10, how did you get 10? Where did you get 10 from? Please just give me a minute. I try to find out. Number? Oh, okay, number 5. You know, I was... I've got you. I've got you. Thank you. I was wondering how. Okay. It is not what you are saying. It is here. Reserve on long-term investment was 10. This is what I had read. I was wondering where I had read it. It is not what you are saying there. Reserve, I was looking for something specifically on long-term investment. It is not what you have identified as working 5, working 6, no. Reserve on long-term investment was 10. In first year, it was 0. In second year, it was 10. So it is 10. So reserve is 10. So reserve is 10. It is that additional information. So reserve on what? Long-term investment. Investment is how much? 10 minus 0. Because we don't have something at the beginning. 10 minus 0 is still what? 10. Okay, so we are done with that. So 60 plus 10, what does it give you? Okay, this side is more. That is good. This side is more. That was 70. This is what? 80. So the one that is more is what we post on both sides, 80. So if the one here, it means, what does that mean? There was purchase of long-term investment. Purchase of what? Long-term. Purchase of long-term investment. So it is a balancing figure. It has really taken me time to look for that, but it's good I've got it. 80 minus, that is why we always start by reading, so that if you miss out anything, you can remember. So we could have easily left out that, but it's good I read it at the beginning when we were reading through the question one by one. So purchase is 10. So working 13. Where there is working 13, it's 10. Wow. So this is 10. Let me pick it from the source. Just be patient with me a bit, please. I'm also sympathizing with you the way this question was difficult. Even to me, it is difficult. But let's just hope patience will help us at the end. Dividends received from associate is working now. It will now not be working 13. It will now not be working 14. Where is it? Working 14. Please just be working 14. So this is dividends. Dividends received from associate. Dividends received from associate. Remember, dividends received, we can only get it through two ways. We can open an investment in associate account, investment in associate account. Were we given investment in associate? That is the first way. Were we given investment in associates in the balance sheet? Let's hope it is there. Yes, then that makes it easy. Investment in associate, 38 and 32. Opening is 32, closing is 38. Opening is 32, closing is 38. Opening is 32. Where is it? Opening is 32, balance brought down. This is 32, closing balance carried down is how much? 38. And there was profit for the year. You know, profit of the year, profit from what? Associate. Associate, of course, it is where? In the income statement. Profit from associate is in the income statement. I hope it was given in the income statement. Yes, 8. So the balance gives you the dividends received. Balance is dividends received. So this is what? 8. So which side is more? Yeah, this side is more. So if it was this side that is more, it is dividends paid. If it is this side that is more, it is dividends received. Cash paid is on the debit side. Cash received is on the credit side. So is equals to 32 plus 8. Hey, these workings are many. So cash what? Received. If it is on, so that is a balancing figure. So these workings were really a lot. 40 minus 38. So that gives you 2. We are done, we are done, we are done, we are done. 2. That gives you working 14 is 2. Working 14 is giving us an answer of 2. Working 14 is giving us an answer of 2. We are done, we are done, we are done. Just 3 more minutes and we finish. I just hope that it will balance, because after all that work, so yeah, it gives you 2. So let's find the net cash. Net cash, remember this is a negative, is minus 100 plus 8 minus 10 minus 200 plus 10 plus plus 2. What do we get? Minus 290. So investing net cash used in investing activities is that. Net cash used in investing activities is that. So what else is remaining? The others, instead of working, because I know we are fatigued, the others, what we can do, I can just take this because we had already looked at it. 200 million minus 20 million. 20 million, which is, the 20 million is the bonus. Bonus. So remember the 20 million bonus, because bonus, that gives, that is how somebody was asking how we got 120. Remember, how did we get 180? Look at here. Look at here. Ordinary shares was 300 million minus 200 is 100 million. 140 million minus 40 million is 100. So 100 plus 100 is 200 million issue shares. But there was shares issued for free. There was shares issued for free here, bonus here. So we had already calculated it that it was 20 million. How did we get 20 million? The ratio was 1 for every 10. 1 for every 10. So how do you know the bonus? You come here. Where? You come here and you know that at the beginning we had 200 million divided by 10 is 20 million shares. 20 million shares divided by ratio of 1 to 10 divided by 10 is 2 million shares. 2 million shares times 10 is 20 million. So that one is already given. So I don't need to take time there. Oh, we still have something. Cash received from borrowed. Yeah, this one is also not complicated. We can just calculate it directly. So we can also calculate cash received from 10% loan notes. So 10% loan notes, where is it? Loan is non-current liabilities. So loan is from 40 to 120. From 40 to 120. So we received, because you can see the loan increased from 40 to 120. So look at what I'm doing. 120 minus 40. It's telling us we received a loan of 120 minus 40. How much is that? 80. Bank loan reduced. Bank loan, remember we had posted those when we were looking at it. So bank loan reduced from 60 to 44. Bank loan reduced from 60 to what? 44. So what is our bank loan? Is equals to 60 minus 44. So what does that give us? It gives us 16. Remember repayment is a less. Receive is what? Add. Receipt is an addition. Next, issue of shares is an add. It is an addition. Wow, this was tough. So 180 plus 80 minus 16 to 44. So what is it called? Net cash from financing activities. Financing activities. Let us be attentive. So this we said, you remember we worked backwards and we found the answer should be 74. If I get this 74, it means all those workings are right. So let me just remove them. This one I was just showing you shortcut, but let me just remove to confirm. So let's see this. If it is 74, everything is right. 120 plus negative 290 plus 244. Let's see. It has worked out. 74. So we have got 74. So our cash flow is right. Remember, it was an overdraft. So an overdraft is deducted. An overdraft is deducted. So where is our overdraft? Overdraft was 46. So negative 46. I was at some point worried that it will not balance. 46. But remember, it is less. So 74, because it was an overdraft, we less 46. What does it give you? 28 is the closing cash. 28 is the closing cash. Where is the cash? 28. You can see it there. And that brings us to the end of cash flows. Please practice. I'm very sorry to those people who sat in that sitting. Sometimes maybe you did not pray well. So this time, remember to pray in advance. Pray at this point, because this is the time the exams are being set, not in exams time. It has balanced. So that is good. Okay, somebody's asking me to explain the bonus issue, but the energy, is it even there? So remember the bonus issue. So let me just remove this because we don't need it. Somebody's asking me to explain the bonus. So bonus was 1 for every 10 shares. So how many shares were there? How many shares were there? Shares is equals to 200 million, 200, let me put it, 200 million divided by, the rate was 10 Rwandese francs. Rwandese francs of 10 per share. So this is 200 million Rwandese francs. So somebody has asked me to do that. But of course I'm, okay. So this gives you 200 divided by 10. What does that give you? Because we are, okay. Let me just write in full. So divide by 10. What does it give you? 20 million shares. So what will be the bonus shares? Just give me a minute so that you don't say bonus shares will be 20 million shares. 20 million, sorry. 20 million shares times 1 everything divided by 10, the ratio. 10, remember, is the ratio. So that gives you how much? So it gives you 20 million times 1 divided by 10. It was that ratio. So it gives you 2 million what? Shares. Bonus shares. Bonus shares. Now, bonus shares are normally issued at nominal price. Bonus shares are normally issued at nominal price. Are normally issued at nominal price, which is equals to 2 million shares times Rwandese francs 10 per share. So that gives you how much? It gives you these 2 million. It gives you the 2 million times 10. So how much does it give you? 20 million. So 20 million. So that is 20 million. So look at this: share capital, and share premium. Share premium. Share capital and share, please just be patient. I'm just trying to explain to that person, and then we wind up the class. So it was 300 million minus 200 million, which gives you so 300 million minus 300 million minus 200 million, it gives you 100. And this one was 140 million minus 40 million. What does it give you? Is equals to 140 million minus 40 million. I'm good in remembering figures, so that is what we have. So you less bonus of 20 million. So what do we get? So is equals to 100 minus 20 million. So it gives you 80, and this one is 100. So when you have total cash received from issue of what? Shares. Total cash received from issue of shares is equals to 80 plus 100. That gives you 180. It's good you have asked. So because you have asked, let me add that as working 15. Issue of cash received from issue of shares. I just did that at the beginning, that is why. So cash received, thank you for asking, even though we are tired, but at least I've now done it. So that is so that instead of just writing guesswork there, we can just now write here, working 15. Is it working 15? Yes, it is working 15. Otherwise, that is where I don't have energy at all to cover ratios. So we will see when to make up for the class of ratios. I know even if I told you we continue, we don't have energy. So, but ratios will not take us more than 2 hours. So let's just stop there. In our next class, we'll cover ratios. Thank you, but it's good it has balanced. That is the most important thing. So I'll be sharing with you this in a short while. I'll be sharing with you this in the group in a short while. Thank you. Have a nice weekend. So let's stop the class there. Thank you. See you next time. See you on Wednesday. Keep time on Wednesday at 6:15. You know, by the time Sunday reaches, sometimes we are very tired because I start teaching Friday evening, Saturday morning, Saturday afternoon, Saturday evening. By the time Sunday reaches, we are really worked out. So, but it's okay. It's for a good cause. Please make sure you now don't disappoint me. Make sure you understand, and by not disappointing me is passing in exams. So make sure all these efforts should not go for no reason. So make sure you are in a position to do it, practice as much as possible so that you can. The class is ended. We are not in a position to continue. We are not in a position to continue. The class is ended. Let us meet on Wednesday. Are you sure you did not receive Excel sheet for income tax? Maybe because I did not complete. I will send it when I complete income tax on Wednesday. I'll send it when we complete income tax on Wednesday. I'm just editing so that I can send it. Esther, I'm not an admin. I could have added you, but I'm not an admin in that group. It is a group of students, so find out who the class representative is so that he can add you. Or just find out who the admin is. I could have added you if I was an admin.